Hey guys, welcome to another recording session of Money with Friends. Normally we'd sit here and hang out, but we have a deadline. I'm going
Yes.
to talk in about 2 hours, and I still got to get ready. Uh,
Yes.
I know all this can actually look better. I know, shocking,
You're a
but
man in demand. There's a big audience waiting for you.
it's going to be fun. We
Yeah.
actually talking about the creativity in podcasting in Detroit, which is cool. And Bobby's gone, so we are going to hang out here for just a second.
We have to do this,
So,
and we have to do this, and that should work now. How's
yeah,
that? I'm
let me
back.
get you back. Yay,
Yay, and we have a few friends here.
that's
This is
good.
so awesome because we are new to YouTube, and we are just starting to let people know that we're here, so we're hoping people migrate over and join us. This
Welcome to
is
YouTube, guys.
awesome.
All
Yay.
right. We ready? We ready? Yeah. Don't forget about me. I'm here too. Right. All
Yay.
right. We ready to make a podcast, Bobby?
Yes, we are.
Yeah, we are flying, guys. So time.
Get
Time.
those comments in early.
All
Early
right.
and often, right? Yeah.
Here we go.
All right. Have you pressed record?
I have. Yeah.
Okay.
We didn't do that last.
Just checking. Our friends know what we're talking about. All right, here we go. If you are shopping for some new investments or just checking in on your mutual funds, we have information you need to hear about how to evaluate these funds. And yes, we're going to get judgy with some data that may change your mind on how you pick where to put your money. That and so much more on this edition of Money with Friends. Welcome to the Money with Friends podcast. I am certified financial planner Bobby Rebel, host of the Financial Grown Up podcast, coming to you from my very grown up kitchen in New York City.
And coming to you from the Motor City, Detroit, Michigan, where we make the Stacky Benjamin Show. I'm Joe Salsihai.
This is the Money News Show that includes commentary on recent headlines and stories with thought leaders from across the financial landscape. We break those stories down into what matters to you, our friends, and we leave you with a takeaway to make it your own.
Today's show is brought to you by Tiller Money, your financial life in a spreadsheet, automatically updated every day. Only Tiller Money automatically updates Google Sheets or Excel. You choose with your daily spending, transactions, and account balances. Try Tiller free and get 20% off your subscription if you head to tillerhq.com/MWF. That's toward your first year. Thanks to them for that. Thanks to everybody who used our link for going there. And Bobby, thanks to you for this topic, because a lot of people at the end of the year, I've seen over and over all of these lists, right? Top movies of the year, top TV shows of the year, and top mutual funds of the year, top investments to invest in from last year. And that might not be what you want to do.
Well, and it's not a thumbs up or thumbs down. There's actually a lot of nuance to what you should be thinking about. And we'll see. I see we have a live audience here. We're taping this on YouTube, and they're already speculating what it's going to be.
Well, no speculation here. Let's get into it. But first, let's see which one of our friends is going to help us kick off today's show. All right, this piece comes to us from the Wall Street Journal, written by Suzanne McGee. Suzanne writes, the pros and cons of using 12-month returns to evaluate a mutual fund. Past performance is no guarantee of future results. The Securities and Exchange Commission requires mutual fund management companies to remind current and potential investors of that fact in every prospectus and as part of every marketing pitch. That doesn't mean, however, that historical returns can't provide useful insight into a fund. In particular, they tell us how well a management team and their strategy performed for existing investors and how in sync that strategy was with what's happening in the broader market. When it comes to making investment decisions, all we really have to rely on is what happened in the past, says Leslie Beck, owner of Compass Wealth Management, LLC in Rutherford, New Jersey. While it might be foolish to expect that history to repeat itself, Ms. Beck still finds careful study of a portfolio manager's record to be useful. Without that information, I don't have any sense of how a manager might fare in a time of crisis or whether the risks they take are paying off.
That is one reason why the Wall Street Journal singles out a handful of actively managed U.S. equity mutual funds that have trounced their peers based on their record over the previous 12 months at the end of every quarter. Another reason is to show how those managers have been rewarded in the short term, either for high risk investment decisions made years ago or because they have been in the right place at the right time. But Is a rolling 12-month analysis the right time frame to use? Certainly, some journal readers believe we should analyze 3, 5, or even 10-year investment returns before identifying a particular fund as a quote winner. Scott Opsahl, director of research at Luthold Group, a Minneapolis-based investment research firm, is one of those critics. Quote, if you owned the top performing stock for each of the past 10 years, its median 1-year return was 181%, and any mutual fund that had, say, a 3% position in that stock would have seen its overall returns boosted by more than 5 percentage points, he says. And this I actually put in bold as a really important sentence, Joe. So 1-year returns really come down to whether or not you own one of those biggest outperformers, whether a big tech giant or a company that was a target of a buyout. That is not a pattern that I would like to invest in.
Yeah,
In other words, they got lucky. The
yeah.
company they own got bought out. Boom.
The piece goes on, and we will link to this on our Twitter feed as you listen to this, because there is a lot more. But I think that's enough, Bobby, for us to get into. I see all the time top fund of last year, top investment of last year. And I get it, seeing who has the hot hand and what's hot now. If you're a momentum investor, which means kind of a short-term investor, that might be helpful. But if I'm a long-term player, I think the best stuff from last year kind of worries me more than helps me.
Well, that's the whole dogs of the Dow theory, right?
Yeah.
There's a rotation. So.
But a lot of people don't even know what the dogs of the Dow is. Explain that to people, because that's an interesting concept.
Oh gosh, you're putting me on the spot. I don't want to say it exactly wrong, but tell me if I'm correct. It's something like the worst performers basically are going to be the best. That there's basically a cyclical pattern, right?
That's a nice job. You
Okay.
are the gold star from mom. You're buying the worst stuff from last year versus the top stuff. There is this idea that when it comes to individual parts of the market, there's this thing called reversion to the mean, meaning if it did really well, it's probably going to come back to the middle. If it's done really poorly, it's probably going to come up. Betting, by the way, full tilt on which one of those is going to do better next generally isn't the best strategy, as just shooting for your goal and then working backwards on what's done that over long periods of time. But the dogs of the Dow is much more interesting to me, by the way, than investing in what was hot last year.
And it's always a nice branding. I want to mention the gentleman quoted that we just spoke about that made that point. He also notes that the difference between the bottom quartile and the top quartile funds in any given year during the past 10 years was a mere 6 percentage points. So getting just a single stock decision right would have been enough to transform a fund from the bottom of the heap to the top, adding that concentrated portfolios would see a still bigger benefit. Looking at longer periods smooths out some of the impact that individual stocks can have on short-term returns.
You know, when they talk about the pros and cons, we just went through the biggest con of looking at 1-year return. When I tried to think of the pros, and they certainly have some in this piece, but a big pro for me was much more around education, getting a handle on how asset classes act over short periods of time. So if I look at, as an example, C Foltz hanging out with us here on YouTube today. By the way, if you want to hang out with us on YouTube, head to youtube.com, put in Money with Friends, and you can watch us make the donuts. But or make the donuts with us, like Ron and C Foltz are. But brings up small cap value as an example. If I look at every year of small cap value, Bobby, just 1 year at a time, a 12-month return, I get a great idea about the amount it bounces around. So I know that while a large company stock, if it goes worse than minus 14%, I know it really is cratering, but 14 is still within a good realm of possibility for large companies. Small cap value can go down significantly more before I should worry. So knowing what the bounce around factor, better known as to professionals, the standard deviation on a stock, the $100 word. The more of an informed investor I'm going to be, and the more comfortable I'm going to be with the ride when I'm in it.
Yes, I do agree. It's important to know what you're investing in and be realistic about the range of returns that you might expect it goes down to risk reward. I mean, there's definitely ways to spread out the risk. And if some fund managers will say, I invest in a very small amount of stocks. I pick one stock a year and I follow them obsessively, and my whole portfolio is under 10 stocks. And some people have done very well with that. And so if you look at that individual manager and believe in their methodology, that can make a lot of sense. And that's why someone like a Warren Buffett, he will literally make headlines when it becomes public knowledge that he's put a lot of money into an individual company or a conglomerate, whatever the investment may be, because we know that his pattern has always been to really evaluate that company, versus other ones may really spread the risk among different companies, or they may have a mandate where they have to buy every company in a sector, that kind of thing. So know what you're buying into.
Yeah, and as is P said, the prospectus will always tell you. Another place I like, Morningstar.com, is a fantastic place to get unbiased research on all of these things. That's the place that I go. I'll tell you the other thing that I like about 1-year returns is looking at how different types of funds compare against each other under different conditions. Because back when I was designing portfolios, Bobby, you'd see that certain asset classes were like putting salt and pepper in a portfolio, and you can really even out the ride. In fact, there was a whole there's a whole thing called modern portfolio theory, which a big piece of that follows something called the efficient frontier, which shows that instead of just buying one asset class, like here we were talking about small cap value earlier, if you put maybe 5 different things together with small cap value, even though they might be risky asset classes by themselves, you put 5 risky asset classes together, you can smooth out the plane ride and decreasing the risk and get much more consistent good returns by doing that. And by the way, Dr. Harry Markowitz won the Nobel Prize for that research, and a lot of people use it. So go Google efficient frontier, and you'll see some pretty interesting stuff about looking at the 1-year return and these short time frames to see how these levers pull differently under different conditions.
Yes, I remember studying that for the CFP exam.
Exciting stuff, isn't it?
Yeah, I sort of think I blocked some of that out, Joe. After I took, how you take a test and then you really know it well for the test, and then it's just gone. So thank you for that explainer, Professor.
I always thought it was fantastic. When you use it every day, like I used to, it becomes a lot more fun. When you would take a look at somebody's portfolio and how it's off the efficient frontier, and then you show them just by moving, you could take a lot what seemed to be moving into riskier type positions, but moving into several of them, that you were able to actually decrease your risk and increase return. Even though if you looked at each individual position, it looked riskier. Putting them together decreased it. It was fascinating. I could nerd out on that stuff all day.
As you are.
And right, in just a second, we're going to nerd out about our big takeaway here. She's like, there's one of us that's excited by this, Joe.
I passed the test. Okay.
In just a second, Bobby and I are going to have a big takeaway. But before we get there, I want to talk just a little bit about Tiller, because Tiller is how I track my expenses. An important part of getting where you want to go here in 2020 in the roaring 20s is by knowing where you've been. And to do that, you need to pick a tracker. Now, there's lots of different ways you can go. I prefer to have a spreadsheet, even though I'm not a spreadsheet guy. I like spreadsheets because every single app that I've tried has had something that I just didn't like. Cool thing I found out about Tiller, stuff I didn't like there too. I could change it though, because it was a spreadsheet. And that was the big aha. When I first heard it was spreadsheets, I went, oh, no, thank you. But I can simplify it because it's a spreadsheet, where if you're a spreadsheet nerd, you want to parse the data more and have even more stuff at your fingertips, you can go that way too. So even if you and I want to do things completely differently, we can use this same app, Tiller Money, to get where we want to go. Head to tillerhq.com, and for 20% off your subscription for the first year, head to tillerhq.com/MWF, and you can score that if you decide to use it. So big thanks to Tiller for helping out the show. What's your takeaway here, Bobby?
My takeaway is, first of all, I want everyone to go to our website and read the full article because it's a very large Wall Street Journal article, very well researched. I really enjoyed it. We could only share part of it on the show. So if you go to moneywithfriendspodcast.com and go to the date that this episode first airs, you can find a link to the article. There's lots of interesting charts that illustrate a lot of what we were talking about because it is a lot to take in. So I want people to first take the time to educate themselves and learn more. I like what they say towards the end of the article, and we didn't get into this. And basically, it is that you should focus on the mission of the fund. We actually alluded to it in terms of knowing what risk and what to expect. But think about how the fund is going to do relative to the peer group with the same goals. So first, figure out what your goals are, and then within that, within the funds that will achieve that goal, then you can look and make some comparisons. And obviously, always look out for the fact that sometimes managers do change. And so make sure that whatever returns you're talking about are tied to the person that is running the money right at that time.
Yeah, it's like a sports team changing a coach or the people that are on the field is going to be very similar if you're a sports fan and get that analogy. If you don't, trust me, the game plays different with different players. When it comes to my takeaway, it's that we often hear that looking at 1-year returns are bad. If you follow money a lot, they say it's bad, but it can be helpful. It can be very helpful, especially when you're designing your portfolio, looking at how these different investments bounce around. And the one thing that we see a lot, and you and I, Bobby, talk about a lot, is that people ruin their own financial strategy by not sticking to it. When the market starts to go haywire, we lose our strategy. The reason is that our funds start bouncing around in ways that we didn't expect. And the more we can model that, and the more we can experience what should be practical for our investments, the more we see that ahead of time, the less likely we are to ruin our strategy when the worst comes. Because at some point, our strategy is going to get tested.
Yes, and maybe sooner than we would like.
Yeah. Yeah.
Very well said.
In this case, though, man, this market just keeps humming along. It's fantastic.
Don't say that too much, Joe.
You can ruin it for all of us, Joe. Don't ruin it. Yeah. Hey, big thanks to everybody who hung out with us here on YouTube today. We actually have people hanging out with us on YouTube, which is awesome. Our brand new home. We're still over on Facebook sometimes, but you're finding us more and more often here on YouTube. Head to youtube.com, put in Money with Friends, and click subscribe, and you'll get a notice whenever we go live, which we're doing a lot here today as we do.
Yes.
Massive recording ahead. Bobby, people can also help us design the show on Instagram. They can be a part of the show and participate in a lot of our episodes.
Yes.
Where can they find us there?
Go to @MoneyFriendsPod. That's our handle, by the way, both on Instagram and on Twitter. And stay close to the Instagram stories because we do often post quizzes and polls and surveys that you guys can participate in and be part of the show, even if you can't be here for the live tapings.
Bobby and I are back here again on Monday with another exciting headline. We're talking mortgages on Monday.
Big mortgages.
Well, and you know what? I'm going to make some points.
Really big mortgages.
Well, but so even if you've got a little tiny mortgage, I'm going to make some points that apply to us all. But you're right. We're talking about some problems in the big old mortgage business. On behalf of Bobby, I'm Joe. We'll see you next time back here at Money with Friends. 15.
Okay. What is the limit now? Or we're going to take a break quickly, and then I'm going to try to look up a little fact.
See everybody right back here in a couple minutes.